Did you know that one investment mistake could cost you a fortune and set your financial plans back years? Imagine turning those mistakes into valuable lessons that set you up for success. Welcome to Bon Bon Legacy, where money meets mindset and meaning. Together, we uncover what you need to thrive in life and secure your financial future. In today's guide, we'll walk through the 7 critical investment mistakes you need to avoid, arming you with the knowledge to take control of your financial journey. So, grab a notebook, because these are tips you don't want to miss. Mistake number 1. Ignoring risk management. The danger of putting all your eggs in one basket. Imagine investing all your savings into one hot stock, only to see it crash overnight. Sound familiar? 85% of investors fail to diversify properly, leading to catastrophic losses. How to manage risk. Diversify your investments across multiple asset classes, stocks, bonds, real estate. Invest in different sectors like technology, healthcare, and utilities. Include global investments to reduce regional risks. Use low-cost index funds or ETFs to easily diversify your portfolio. Many investors during the dot-com bubble heavily relied on tech stocks and lost everything when the market crashed. Diversification doesn't eliminate risk, but it makes it manageable. Mistake number 2. Following market hype, chasing trends instead of fundamentals. Have you ever bought something just because everyone else was doing it? 70% of retail investors buy into market hype, often at the peak of the bubble. Examples of hype: the GameStop rally, cryptocurrency surges, meme stocks. When everyone is talking about an investment, it's often too late. Focus on fundamentals, earnings, revenue, and long-term growth. Research investments thoroughly instead of following social media trends. Mistake number 3. Timing the market. Why market timing rarely works? You sell all your stocks during a market dip, only to watch the market rebound just days later. Studies consistently show that long-term investors outperform those who frequently trade. A smarter approach: dollar cost averaging, DCA. Invest a fixed amount at regular intervals, regardless of market conditions. Example: $500 invested monthly in an S&P 500 index fund over 10 years. It's time in the market, not timing the market, that builds wealth. Mistake number 4. Neglecting research. Investing blindly is a costly mistake. Would you buy a car without knowing its mileage or service history? Then why invest without doing your homework? Only 10% of investors conduct thorough research before investing. How to research investments. 1. Company fundamentals, revenue growth, profitability, and debt levels. 2. Risk factors, industry trends, competition, and market conditions. 3. Investment vehicles, learn the pros and cons of stocks, bonds, and ETFs. Example: Theranos collapsed due to poor fundamentals despite massive hype. The more you know, the better your investments will grow. Mistake number 5. Overlooking fees, hidden costs that drain your wealth. Fees can eat away 40% of your returns over time. 1. Common investment fees. 2. Management fees. 3. Trading fees. 4. Expense ratios. Choose low-cost ETFs or index funds to minimize fees. Use fee calculators to see how costs affect long-term growth. Example: a portfolio with 2% fees versus 0.5% fees over 20 years can show a significant difference in returns. Mistake number 6. Emotional investing. How emotions ruin returns. Have you ever panic sold during a downturn, only to regret it later? Fear and greed lead to over 90% of poor investment decisions. Common behavioral traps. 1. Overconfidence during bull markets. 2. Panic selling during bear markets. How to control emotions. 1. Create a written investment plan for different market scenarios. 2. Stay focused on long-term goals, not short-term emotions. Example: investors who stayed calm during the 2008 financial crisis saw massive gains in the recovery. Mistake number 7. Lack of clear goals. Why investing without a plan is risky? Investing without a goal is like driving without a destination. You'll waste time and resources. Investors with clear goals are 3x more likely to succeed. How to set smart investment goals. Specific: define what you're saving for. Measurable: Set clear financial milestones. Achievable. Ensure realistic expectations. Relevant. Align with your financial situation. Time-bound. Set deadlines for each goal. Align short-term goals, for example, buying a house, with safer investments. Align long-term goals, for example, retirement, with higher growth assets. Example, creating a retirement savings plan based on desired income and timeline. Recap of the 7 mistakes: ignoring risk management, following market hype, timing the market, neglecting research, overlooking fees, emotional investing, and finally, lack of clear goals. Investing isn't about perfection, it's about progress. Learn from these mistakes and grow your wealth smartly. Have you made any of these mistakes? Share your experiences in the comments below. Like, subscribe, and hit the bell to join the Bon Bon Legacy. Your financial future is in your hands. Let's build a legacy together.